in the last year's paper. So the first part is a theory part, and the second part is a practical of 10 marks on evaluation of credit policy. So let's try and attempt this question. Zee Limited is planning to tighten its present credit policy. Existing sales are 60 lakh, while the proposed credit policy will decrease the sales to 48 lakh rupees. So, which means you have two case scenarios. One is the existing credit policy, and you have the proposed policy. Now, under the existing policy, the sales are 60 lakh, while they will be 48 lakh under the proposed policy. Now, the average age of accounts receivable would reduce from 60 days. Your credit period here is 60 days, and that gets reduced to 45 days. Selling price is 40, while the variable cost is rupees 30. On the volume of 1,50,000, the average cost is 34. So you assume a year of 360 days and advise whether the proposed credit policy should be implemented if the required rate of return is 25%. So first thing is that we calculate the operating profit. Then we calculate the cost of investment in receivables. The difference of the two gives you the net profit. So we start with the variable cost. So I think we can write down the units also. Okay, we'll first start. So variable cost is 30 rupees. So for 45 lakh will be the variable cost. And solving for the existing policy, you can then solve for the proposed policy. So contribution will be 15 lakh. Now we need to reduce the fixed cost. Now in the question you are not given the fixed cost explicitly, you are given that the average cost is 34. Now average cost is sum total of variable cost and fixed cost per unit. So your variable cost is already given as 30. This means that the fixed cost is 4 rupees per unit. 34 minus 30. At 4 rupees per unit, your fixed cost comes to 6 lakh rupees. And now this cost remains same irrespective of the level of production, which means your operating profit, that is point A, comes to 9 lakh under the existing scenario. Then we need to calculate the cost of investment in receivables. So first thing is we calculate what is the investment in accounts receivable. The formula for this is your total cost into credit period divided by number of days. So total cost is 51 lakh. and credit period is 60 days. So accordingly, you will get your investment. Investment in receivables is 8,50,000. Cost of investment in receivables. That is what we want as point B. So that will be 25% of 8,50,000, 2,12,500. So 6,87,500 is your net profit. In the same manner, calculate the net profit for the proposed credit policy, and let's see whether there is an increase or decrease. To calculate the working under proposed policy, you first need to calculate the number of units sold. Just check how much will be number of units sold. So 48 lakh is the total sales. 40 rupees is the selling price per unit. So that gives you 1,20,000 units sold under proposed policy. Now please complete the remaining steps. Yes, what is the answer for proposed policy? Is anyone solving the question? Okay, take 2 minutes more and let me know what the answer is coming to. Yes, yes, Megha, have you solved the question? Megha, Sahil, solving it's not
मैम
that
ट्राई
lengthy.
किया था मैम, फिर हो नहीं रहा है मैम।
क्यों नहीं हो रहा? कितना आ रहा है? ऑपरेटिंग प्रॉफिट कितना आ रहा है? यस, साहिल, उन्नति, from my side, the syllabus is over. What's the point of practicing questions then? Yes, solve हुआ आपसे question?